Hey everyone, welcome back to the channel. Today we're going to talk about stock splits. Recently in the news we've seen Amazon, Google, Tesla, and GameStop all announce stock splits. So today we're going to talk about what they are, how they're done, and why companies do them, and what they mean for you as an investor. A stock split is when a company issues X number of shares to current shareholders for free, and as a result the stock price will decrease by the stock price divided by X. So for example, if a company has 1 million shares outstanding, trading at $10 per share, and issues a 2-for-1 stock split, you will receive 2 shares in exchange for every 1 share you own. This will increase the total number of outstanding shares to 2 million shares for the company, with a price now of $5 per share. If you had 100 shares worth $10 per share before the split, you would now have 200 shares worth $5 per share after the split. Your total position in dollar amount will stay the same in theory at $1,000. You'll just now own more shares that are worth less per share. There's 2 ways a company can issue a stock split. The first is what most people think of, and it's a traditional stock split. The company creates new shares and issues them to the current shareholders. Now, the second way is through something called a stock dividend. Shareholders, instead of receiving a cash dividend, would receive a stock dividend. The end result of both ways is actually the same. There is no underlying difference in the final result. The only difference is from an accounting standpoint. In a normal stock split, a company will increase their common shares outstanding and then proportionally reduce the par value. So this will have a net zero impact on the balance sheet. And if we quickly look at a balance sheet, we could see here where the common stock account is. This would increase, and then the par value right below it would actually decrease. In a stock dividend, a company will actually book a journal entry and move retained earnings into common stock, thus increasing the common stock account by the dollar amount necessary to cover the number of shares at par value. So looking at the balance sheet again, we would see retained earnings would decrease and common stock would increase. It's really just a difference in accounting, and both are net zero to the balance sheet. There is no difference in the underlying operation of what is going on. There is speculation online right now about how short sellers might be impacted by stock dividends and will have to provide shares. This simply just isn't the case. In a cash dividend, that is correct. A short seller would need to provide the cash. With a stock dividend, a broker-dealer will actually treat this the same as a stock split and adjust the underlying options contract. If you don't believe me, just wait until the GameStop stock dividend happens and the short squeeze does not happen as a result of this. But anyways, moving on to why companies perform stock dividends or stock splits, there's a few main reasons, with the first being liquidity. A good example to highlight liquidity problems is Berkshire A shares. They've never been split and they currently trade at around $500,000 per share. If we look, they have an average volume of 22 shares a day being traded. We can see Berkshire B shares, however, that trade at $350 a share have an average volume of 5.4 million shares per day. If Berkshire didn't have the B shares, the stock would basically be illiquid. What can end up happening is a company IPOs, goes on a large run, the stock starts trending upwards after a handful of years, think Google, Amazon, Tesla, and the share price starts to get well into a few $1,000s a share. And at those levels, it's historically been difficult for retail investors with smaller accounts to participate in buying shares. Liquidity doesn't completely dry up, but it does decrease. So a company will issue a stock split that will make the stock price much more attractive for retail investors. The second reason is a lot of investors will buy what is called a board lot, which is a lot of 100 shares. This allows for a handful of option strategies like covered calls and other things. But you need significant quantities of the stock a lot of the time to do these trades. With too high of a price, the options market could actually see reduced volume as well, which is not a good sign. So a split will lower the price, making it cheaper to acquire a board lot, making it easier to do these trades. The last area to cover are reasons kind of outside of liquidity, and the main factor for a stock split outside of liquidity, I believe, is stock-based compensation. This has been on the rise the last few years for technology firms. I think Amazon is kind of the best example of this currently, and while they haven't came out directly and said this is why, I truly believe without a doubt stock-based compensation plays an influence on Amazon's decision. So Amazon issues stock-based compensation to a majority of employees, including those that work in warehouses. I have a handful of friends that receive 1 share annually, and they've been getting this for the last 5 or 6 years, and it has a 3 to 4 year vesting period. Now, if you go back to 2018, that would cost Amazon $1,500 annually per employee for the warehouse folks. Today, the cost has doubled to $3,000 because the stock has appreciated so much. For Amazon, performing the stock split is actually going to allow them to pick the dollar amount they want to give each warehouse or entry-level employee and have it not be reliant on the minimum price Amazon stock trades at. This will allow them to give employees 10 shares that are now worth $1,500 versus one share at $3,000, and they'll have a lot more control over the actual grant amount and actually cut operating costs in the process. I honestly would not be surprised if we saw a 15 to 25% drop in stock-based compensation for Amazon in, call it, a year or two, once things kind of normalize and equity refreshes have been issued, as they're probably going to set a minimum $1,000 grant for entry-level workers, whereas it was previously one share or $3,000. The final reason I'll hit on is recently, stock splits usually are a sign of a bull run. Retail loves them recently for whatever reason, and the stock tends to rally pretty well after they are issued. Just looking at Tesla and Apple, it's pretty easy to see how the stocks have trended upwards after stock splits have occurred. Now, the gain in the market isn't only related to these splits, but it does play a role without a doubt. Now, the last thing to hit on though is what this means for you as an investor. In theory, a stock split will have zero impact on your investments. Nothing new to the business is fundamentally changing. However, we can see time and time again, before a split occurs, we tend to see a run up in the price, then there's a quick pullback, and then usually another run up to a kind of new range that the stock will trade at. And once again, if we look back at Tesla and Apple, we see this phenomenon, and a Reddit user recently actually pulled together some interesting data points on over 2,000 stock splits. I'll link the post and his research below, but it kind of confirms what we've seen in Apple and Tesla. Right after the announcement date until the expected date, we see almost double the return for these companies issuing stock splits versus the S&P. And then immediately after the stock split, we actually see a small pullback and about double the loss of the S&P. But if you hold for a year after the split, you will see about a 2% higher return than the S&P. Something to note here is I don't think the split is the cause of the outperformance, but rather a byproduct of it. For a company to want to split their stock, they need to be performing well. And usually they'll have seen significant market gains in the recent past. That success in the market is probably not going to just go away after issuing a split. The business will still be performing well and beating earnings most likely. So the split is more a product of a successful company rather than a company's success being the product of a stock split. In general, I would say a stock split is a good sign that is usually an indicator the market likes the stock and the company has been performing well in recent times. So anyways, that's all I had today about stock splits. I hope you found this interesting. If you have any questions, leave them below. And if you haven't already, please like and subscribe. Thanks so much.